Long-dated United States yields at 19-year highs, oil holding above $90, and a softer dollar are forcing a rethink of risk across every major asset class. Welcome to vTalkInsight, Allocator's Lens Daily for July 31st, 2026. Let's start with equities, where strong mega-cap earnings are colliding with higher discount rates and an energy shock. In equities, the tape is being held up by a handful of mega-cap names even as the broader market struggles with higher yields. Despite the recent pullback and an 11% correction from the June peak in the Nasdaq, strong results from companies like Microsoft, Apple, and Amazon are keeping headline indices surprisingly resilient. Microsoft's latest quarter underlined how powerful the artificial intelligence theme still is, with Azure cloud revenues growing over 40% and guidance stepping up again. Amazon is showing similar momentum, with cloud and AI-related services beating expectations and early signs that proprietary chips and software layers can support attractive margins and sizable recurring revenue. These stories help explain why technology, media, and telecom now account for roughly half of the United States' large-cap market value, cushioning indices even as many constituents trade lower. Under the surface, breadth looks fragile. On days when the S&P 500 rallies, most members are often flat or down, and the Nasdaq's extended losing streak earlier this week shows how sensitive high-growth names are to long yields north of 5%. We see the market rewarding clear, cash-generative stories like Starbucks, Lloyd's, and logistics names that are improving margins and balance sheets, while punishing companies such as Meta and Adidas, where heavy spending or opaque payoffs cloud the earnings path. Outside the United States, the picture is more balanced. European equities are absorbing higher energy costs and yields, but are seeing earnings upgrades in banks and manufacturing, supported by improving purchasing manager data. London, which largely missed the speculative surge in United States and Korean tech, has quietly pushed to record highs, backed by demand for quality franchises and a strong pipeline of initial public offerings set to come after the summer. The equity risk-reward now hinges on how far long-term rates and energy prices run. 30-year Treasury yields above 5.2% raise the hurdle rate for growth and share buybacks, while Brent above $90 threatens margins for energy-intensive sectors even as it boosts integrated oil and refining names. With the volatility index back in the high teens after swinging sharply this week, allocators are facing a market where index levels look calm, but underlying dispersion by sector, region, and balance sheet strength is widening. The next test for equities will come from how earnings guidance, especially around artificial intelligence capex and consumer demand, evolves against this backdrop of tighter financial conditions and an energy shock. Turning to rates, the dominant story is a bear steepening of the United States curve driven by questions over central bank credibility. 30-year Treasury yields have pushed to around 5.2%, the highest levels in almost 2 decades, as investors demand more compensation for inflation and fiscal risk. That move has come alongside heavy Treasury issuance and a perception that the central bank's latest press conference muddied, rather than clarified, its commitment to the inflation target. At the front end, markets are now assigning roughly a 2/3 chance of a rate increase in September and pricing in several additional moves over the next couple of years. Investors appear to be signaling that hawkish speeches are no longer enough. They want concrete action and a clearer reaction function if inflation stays sticky. Yet the data are mixed, with core personal consumption expenditures up only 0.1% month-on-month and annual core inflation easing toward the low 3% area, while second quarter growth has slowed to around 1.5%. Globally, the pressure on yields is broad-based. Changes in Bank of Japan and European Central Bank policy are adding to term premia, and United Kingdom gilts show how central banks are trying to balance higher energy-driven prices with signs of domestic disinflation. The Bank of England kept its policy rate on hold, even as some members argued for hikes, and with inflation they're already close to target and projected to dip below it. Markets doubt how much further tightening is realistic. For allocators, the key risk is that long-dated yields become unanchored, turning bonds from diversifiers into amplifiers of volatility. Commentary already flags that if the long end continues to sell off sharply, it could trigger a broad risk-off move across equities, credit, and parts of emerging markets. At the same time, aggregate bond indices now yield around 5%, with corporates closer to 6%, so the income on offer is far more compelling than just a few years ago. The trade-off is clear duration and policy uncertainty risk, especially with the central bank stepping back from firm forward guidance and putting more weight on incoming data. In credit, the strain of higher base rates and massive capital expenditure is becoming more visible, particularly around artificial intelligence and data center themes. Spending on these projects is projected to exceed $1 trillion next year, much of it funded in bond markets. We have already seen landmark deals, such as tens of billions raised by large platform companies, as well as banks testing appetite for multi-billion-dollar issues at a time when investors are more selective. Risk premia are warming up most in the more speculative parts of technology. Bonds of highly leveraged or less proven artificial intelligence names have underperformed, with some, like specialized cloud infrastructure providers, seeing notable price declines and wider spreads. Commentary also points to nervousness around new issuance from financial institutions after a sell-off in AI-related debt, underlining that the window for funding is still open but narrower. The flip side is that investors taking credit risk are being compensated with higher coupons and better structures. There are reports of wider spreads, stronger covenants, and more issuer-friendly, but also lender-protective, documentation on new deals, especially for high-quality borrowers. Some see this as an environment where well-underwritten credit can deliver attractive returns, provided leverage, duration, and sector concentration are carefully managed. The main concern is that rising yields and shrinking liquidity eventually trigger a market event. Longer duration credit is exposed to both spread widening and rate moves as the curve steepens, and sectors with heavy cash burn or ongoing equity issuance, such as some parts of tech, look especially vulnerable. Against that, large incumbents with strong free cash flow from AI, consumer, or logistics franchises appear better placed to service debt, even if funding costs rise further. How credit markets absorb the next wave of issuance from both corporates and sovereigns will be an important gauge of where the stress line sits. Foreign exchange markets are picking up the same themes of policy ambiguity and shifting growth expectations. After the recent central bank press conference, the dollar weakened as the yield curve steepened, reflecting a sense that rhetoric and actions are not fully aligned on inflation. This softer dollar has helped some oversold trades in semiconductors and commodities, where a weaker greenback tends to support prices, stage tactical rebounds. Policy divergence is reinforcing a more two-way FX tape. The Bank of England is holding rates steady with inflation already close to target and projected to fall below, while still sounding cautious because of energy costs. At the same time, markets think the United States Central Bank may need to restart hikes in September and possibly move more than once, even as domestic inflation data cool at the margin. These cross-currents mean currency flows are increasingly driven by relative real yields and equity narratives rather than a simple dollar up or down view. London's push to 24-hour trading and a stronger initial public offering pipeline, plus resilient European earnings, could attract more international capital if global risk appetite stabilizes. But if long-end United States yields continue to rise sharply, that could reassert dollar strength via higher carry, especially if rate hikes materialize rather than remain just in pricing. Watching how the dollar reacts to the next inflation releases and policy speeches will be crucial for gauging global financial conditions. Commodities, and energy in particular, sit at the center of today's macro story. Brent crude is trading above $90 as conflict around Iran escalates and spreads across the region, with attacks on infrastructure, shipping, and military assets undermining confidence in key transit routes. Traffic through the Strait of Hormuz remains heavily constrained, and some commercial vessels are opting for longer, less conventional routes, adding both cost and time to supply chains. The real tightness, though, is in refined products rather than crude itself. Gasoline inventories are drifting well below seasonal norms as refineries prioritize jet fuel and diesel, and utilization rates in the United States are running in the mid to high 90s, leaving little spare capacity. Wholesale gasoline prices around $140 a barrel versus crude at about 90 translate into exceptionally wide refining margins and strong profitability for complex refiners. At the same time, the United States Strategic Petroleum Reserve has been drawn down to levels that now sit below commercial stocks, reducing the system's buffer against further shocks. Analysts highlight a potential inflection point around September when ongoing drawdowns could tighten West Texas intermediate dynamics noticeably, if not offset. All of this raises the stakes for hurricane season and heat waves, since any weather-related disruption to high-running refineries could quickly push product prices even higher. Industrial metals also present a mixed but important picture. Copper demand is supported by global electrification and the rapid build-out of data centers, which are power and materials intensive, reinforcing a constructive medium-term backdrop. By contrast, steel faces a multi-year surplus, particularly in China, dampening the outlook for that part of the complex and highlighting how uneven the industrial cycle remains. Climate and geopolitics add further layers of risk. Large natural catastrophe losses relative to insured coverage point to a growing protection gap, and scientists are warning about the potential for a powerful El Niño, which could amplify weather disruptions and commodity volatility. Meanwhile, attacks on Russian energy infrastructure, interruptions to diesel exports, and the spread of shipping threats from the Red Sea into the Mediterranean underline how fragile energy logistics have become. For allocators, this means commodities are not just a growth or inflation play, but also a key transmission channel for geopolitical shocks into rates, inflation risk premia, and sector-level equity and credit performance. Across assets, the picture is one of resilient but narrow equity leadership, a bond market demanding higher term premia, credit that offers better carry but thinner liquidity, a dollar that is more sensitive to policy missteps, and commodity markets where energy and weather risks loom large. The balance of risks is shifting toward how long end yields and oil prices evolve from here, because they sit at the junction of inflation expectations, funding costs, and earnings power. Watching the interaction between upcoming inflation and growth data, central bank communication, and the stability of energy supply will be critical for understanding where the next repricing might occur across equities, rates, credit, FX, and commodities. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.